would you assess how your funds are doing this year, given the volatility we've seen?
Well, needless to say, most of our funds are in negative territory, but we're long only. We're not long short in what I do, so that's not surprising. We've had a good run for a few years. But where do we go now, I guess?
Yeah.
And that's the question which I'm sure I'll get asked now.
Well, okay, let's do that.
Yeah.
Where do you think we go second half?
Look, the world is definitely still uncertain. There is volatility, risk is still there. The two key things still, the conflict in Europe. There's still COVID restrictions in a lot of parts in Asia. So the risks are still out there. But having said that, if we look at, first of all, the COVID restrictions, they got to start easing, right? Wherever they are, China obviously one of them. And if we already started to see that investors are looking at good value in a lot of stocks in these areas. You look at China, for instance, the valuations on China today, even though a lot of earnings revisions have taken place downwards, you're still looking at a PE level now into next year of 10 times. And that's knocking off earnings by quite a bit.
But given what's happened in the last year or so, and maybe longer, is there now, do you think, a China discount being built in? And if so, how much is it?
Yeah, that's a fair question. In what we do, and certainly in trying to size up these risks, we have taken a little bit more of a risk premium on Chinese equities, given the volatility in the last few years and certain regulatory changes. We'll have to see how that evolves. But even if you take that little bit more of a risk premium, those valuations are very cheap today. And you see what's going on locally in China. There's definitely easing, which is counter of what other central banks are doing in the rest of the world. There's definitely a footing to stimulate the economy.
But the rest of the world is coming out, with high rates, etc., and possibly slowing down. That's a bad time to be coming out of a recession, as China has been, possibly not a recession, but slowing growth, because your export markets are not going to be as buoyant.
Very true. But the domestic demand sector we believe, will pick up quite strongly with the stimulus, with infrastructure spending, consumer savings coming back out to spend. And we've seen that in other countries as well as COVID opens up. That's why we've got inflation as well, partly.
Is that where most of your conviction is right now, given just where the valuations are, is in China? And where do you rotate from to go back into China now?
Sure. So China's one of our markets we are getting more positive on. We were a bit underweight China. We're moving up there. If we look at Hong Kong and China combined today, we're actually overweight. And that has all China components. But we also like Korea. And we'll probably funding it a bit from Southeast Asia and India. Now, again, fundamentally, we love these places. Compounding earnings growth over multi-year periods. But if you're just looking at tactically over 6 months period or something, maybe you can get some more juice out of China and maybe Korea even.
Well, in terms of determining where you take that funding from within Southeast Asia, I mean, Indonesia, by and large, has just beaten everyone else this year.
Yeah, it's up this year.
You still like Indonesia?
Still like Indonesia over multi-years, but it comes back to valuations, relative valuations.
Okay.
And as you said, Indonesia's done very well. I think it's up 7% in US dollars this year.
Right.
Commodities has obviously been a great play for Indonesia. Macro's looking good. But again, relative valuations, you look at China versus Indonesia right now, China's looking more interesting. India's trading at 19 times multiples for next year. Earnings growth are great. Again,
that's cheap for India, though, actually. Given how historically they have such a, late 20s normally it is.
It's sort of pushing it now.
Yeah.
Pushing it now. But earnings are strong. So again, multi-year, love it. But again, just tactically in the short term. Now, we're not saying we're going zero by any means.
Right.
But just, a bit underweight India, a bit underweight Southeast Asia, and funding it into Northern Asia.
Well, I'm curious now. Now it's the first time in, at least 15 years we've had to deal with generationally high inflation. Discount rates are moving up.
Yeah.
So we talk about India 19, China 10 times. Do you need to start looking at those multiples with, the different set of lenses right now?
Yeah.
Just because the cost of borrowing is going up. I mean, 10 times now is not 10 times it was 3 years ago.
Absolutely. And being completely honest, analysts, sell side and buy side, it's somewhat a new phenomena to a lot of them. Building in higher costs and margins, coming down. They haven't been used for a long time in dealing with increasing cost of inputs by this amount. So filtering that in and being very confident about those input numbers is something we have to be very sure about and be very robust about.
When you hear the World Bank talking about storm clouds are emerging, the stagflation is basically, maybe that scenario is playing out for years to come, is what they're saying. How do you kind of look at equities then? I mean, is there a way to kind of navigate that stagflation scenario to you?
Well, I think having sort of a balanced outcome in your portfolios. I'm just talking about equity. You know, we've seen this rotation into income stocks, for instance. So I think it's reminding investors that yes, there are some great growth stocks there, but have it balanced. You know, have some more income stocks as well, where you get that yield element, and you've got to focus on, and one should anyways, focus on those companies that really have pricing power. You know, they're in a strong sector, they have a comparative advantage, and as prices keep going up, they can pass on that to the consumer.